Closing bell on Wall Street today. Market down over 500 points, 3% on the Dow Jones Industrial Average. The Nasdaq and the S&P 500 are both down big as well. Hi, everyone. I'm Vladimir Duthier. Today's session caps off the worst week for stocks since 2011. We're waiting to talk to Jessica Menton. She's a business reporter for the International Business Times. She's going to join us soon to talk about all this. What has got the market spooked? Well, early this morning, the Chinese government released some numbers on manufacturing that were lower than expected. That has led to ripple effect across the global economies, across the global markets, especially within the emerging markets, which China is considered a part of. They are down big. That has led to stocks getting pummeled, including the dollar, which has strengthened off the back of this as oil has gotten to at least $40 a barrel. It was $100 a barrel just a short time ago. Now, Jessica Menton from the International Business Times joins us now to talk about all this. Jessica, big day today on Wall Street.
This was quite a big day. This was a dramatic day, and the worst day for the U.S. stock market this year. I mean, looking at the Dow at one point down 500 points and still closing down over 400, this is a pretty dramatic drop here.
You know, Jessica, so we should put this in context for the people that are watching this and are worrying. Obviously, this is a significant drop, and there are fears, as we've been pointing out, about what's happening in China, the ripple effects that has had across other economies. But in reality, when you look at these numbers and you look at the historical data that we see from the Dow over the last year or so, even though we're seeing this is the worst week since 2011, this doesn't really mean that this is a long-term correction.
That's actually a very good point, because we've continued to see the Dow as well as the S&P 500 hit incredible highs, especially this year too. Just on May 19th, the Dow hit a record, and now it's down almost 1,700 points since then. But the U.S. stock market also hasn't seen a correction since about 2011. And so when you see these dramatic drops, there does come a time where wealth managers will tell me that a correction is healthy, but if we see losses anywhere between 10 to 12% happen in either the Dow or the S&P 500, that's where it's going to be concerning for the U.S.
And Jessica, tech stocks have been getting hit disproportionately hard. Why is that?
That is a great point, because technology companies are the ones that are more exposed overseas. So you look at the S&P 500, about 40% of the S&P, they get their revenues derived from overseas. And the majority of those are those huge tech companies like Apple, like Intel. So when you see Apple hammered today, that's why, because they get so many of their sales from overseas. And so if you have a stronger U.S. dollar like we're seeing right now, and other currencies around the world are weaker, that's more expensive for those companies to turn that revenue into dollars. They're basically losing money on that end, and that's why you see technology typically tends to be volatile in environments like this.
Now, Jessica, for the viewer who is tuning in and seeing this, and he looks at what we've been showing, which is the Dow down 500 points, and they are going to get spooked. They're going to want to call their financial advisor and say, what should we be doing right now? I mean, the reality is, if you look at the stock market historically, if you're in it for the long term, if you're in it to retire, if you're in it to put your kid to college, this is not great news, but it also, as you point out, may represent an opportunity.
Yes, that could create quite a buying opportunity. And the sectors that have been doing the best this year, healthcare and technology, even though we see a lot of dramatic swings in technology right there, those are typically what have done really, really well. And so if you're looking at the long term, something like this is just a small dip when looking ahead to the future. So I would be thinking, if you want to look towards the long term, healthcare and biotech are the ones that are really, really doing well right now.
Yeah, and I think it's counterintuitive, right? I spent 20 years on Wall Street. It's counterintuitive for investors when they see a day like today, the market down 500 points, and they think to themselves that this is a terrible thing. But the reality is, and people know this, but it's just hard to pull the trigger, you should be buying low. But people get happy when they see the stock market going up. That's actually a terrible time to be buying.
Exactly, exactly. And so people will talk about Apple hitting seeing their stock market drop, especially this month after their earnings from last month. But Apple is actually very undervalued. And so I would think if Apple's cheaper now, that's something I would want to get in because especially in September, that's always a huge month for them when they release their new iPhone and other devices that they unveil. And so I would think if you're looking at those types of companies, now would probably be a good time.
Right. And the other point that that financial advisors always make to investors is, look, if you loved it at this price, right? You own it at this price, which is, 2 days ago, 3 days ago, it was way higher than it is today. It's down today. If you loved it then, you should love it even more today.
Exactly. And something that I would want to point out, typically the most volatile months out of the year are September, followed by October. So we're headed close to that time period now. We're not too far away from September, so we probably will continue to see volatility, but that doesn't necessarily mean that that's a bad thing. And
let's talk just a bit about the U.S. economy. Clearly, also, people sometimes make the erroneous, they think erroneously of the stock market, and they assume that when you see the market down like today, that means that the economy is somehow off as well. But that isn't certainly the case, right? In the United States, our economy, although it's not the greatest, it actually has been doing a lot better over the last year and a half.
Right. Just looking at the most recent labor report, it was actually pretty strong. We saw the unemployment rate remain around 5.3%. We still saw U.S. employers creating over 200,000 jobs. That was a solid report, and really a lot of the volatility today that we were seeing, it was driven by China, but it was also driven by the fact of the Federal Reserve. Next month, a lot of people thought they were going to lift rates, which have remained at crisis levels since the Great Recession. And so when you have good data points like the jobs report, that puts it in favor for them to remain on course. But then when you have China and all of this volatility going on, that then creates a question mark on the Fed's future. And I think that also added to the volatility that we saw today.
And the other interesting data point is that crude has been taking a beating. Oil is down significantly. Certainly here for the U.S. consumer, that can sometimes be a good thing. That means the price of gas at the pump is going to be cheaper. But when you look at some of these other countries that produce oil and sell that oil on the open market, that can sometimes, and many of those countries are emerging markets, that could be something to worry about.
Right. So China, the world's second largest economy, but they're also the biggest commodity consuming country out there. And so if they're not taking as many commodities in, that's going to have those rippling effects on emerging markets, especially the ones that are commodity producing countries like, say, Brazil, very big on exporting oil. So if they're not, you're seeing oil prices down, especially over the last year, and falling below 40 today in afternoon trading, that's going to hurt those types of countries. So it could be good for the U.S. when you look at more consumer-focused economies, because that means more money back in our pockets, and we'll spend more maybe at retailers and things like that. But it has the opposite effect for those types of emerging markets.
And that's something that certainly, if people want to put it in practical terms, you point out Brazil as one of those countries. Brazil is preparing for an Olympics, clearly banking on their oil revenues, the money that they make from selling oil in the open market, to help defray some of the costs of building that infrastructure out. And things like this, in African countries, for example, that rely heavily, Nigeria, for example, more than 85% of the revenue of that government comes from their oil sales, and they are battling terrorism. They are trying to increase the wealth of the people in that country. Those are the things that can have some disastrous effects on the emerging markets.
Right, absolutely.
And so I guess the final question, Jessica, is if an investor is looking at today, the point to them is that this is a significant, 3% down today is a significant drop in the market. But overall, the long-term health of the stock market and by that extension, the U.S. economy is strong.
Yes. Just last week, we saw at one point the Dow plummet 200 points only to regain back the losses and make up for it. And it's quite astounding to see, even we saw volatility this week, but over the last couple of years, if say, for instance, 3 years ago with what was going on with Greece, I feel like the stock market would have reacted very differently then, whereas now we saw Greece almost exit the Eurozone a month ago. But yet, even though we saw volatility in the U.S. markets, they still came back.
Yeah, that's interesting,
that's quite
Jessica.
Interesting.
Yeah,
right.
It is interesting because, the markets didn't react as strongly to what was happening in Greece as they did to what was happening in China. And perhaps that is because China is such a major player on the world stage.
Exactly, because China's so much bigger. It's the world's second largest economy behind the United States, whereas with Greece, it's a tiny fraction. It's only 2% of Europe's overall economy. So I think that's exactly why you're seeing more of those global growth type fears versus not so much maybe a month ago with Greece.
Jessica Menton from the International Business Times. Great discussion. Thank you very much.